Gold hitting record highs this week. Look at that, up almost 50% in the past year. Our guest says that the precious metal is gaining from both its traditional role as a safe haven, but also a hedge against currency depreciation. Let's find out more from Daniel Galley, Senior Commodity Strategist at TD Securities. Daniel, hard to know where to begin. There's more and more talk, though, that the game plan in Washington is to depreciate the U.S. currency to make U.S. exports more competitive. And of course, that would be overwhelmingly likely to be good for gold.
Yeah, Andy, I think that's how a lot of people will look at it. What's curious about this current stage of gold's rally is I actually think that a strong U.S. dollar is contributing to the strength in gold prices, right? One of my core beliefs is that we can learn a lot more about anomalies from anomalies in markets than we can from what markets are actually supposed to do. So if you think about gold's epic performance over the last year, it's actually quite of an anomaly, right? Gold's rallied despite U.S. dollar strength in periods when the U.S. rates were rising as well. Gold's actually only ever had this good of a performance alongside a strong performance in the S&P 500 twice in history. The first time would have been 1933 when the U.S. government decided to revalue gold, and the second time would have been 2009 during an epic or the largest round of quantitative easing at the time. The US gold has also never had this strong of a run outside of a U.S. dollar bear market, right? So clearly the strength in gold prices is a market anomaly, and I think it's telling something for those who are willing to listen. What it's actually telling us is that gold has taken on a new role. The strength in the U.S. dollar is acute enough to catalyze buying activity in gold as a currency depreciation hedge, particularly out of Asia. And this is a trend that we've seen developed over the last 2 years and has come back into the fore as of January of this year.
So current investors in Asia are concerned about the weakness of their own currencies against the greenback?
That's right. And one of the ways that they can protect themselves from that is by buying gold.
And then I'm just trying to think what else. We do have a distortion in the market, though, don't we? We've heard these reports of vast amounts of gold being shipped across the Atlantic because hedge funds and the like in the U.S. want to have gold in case Trump puts tariffs on it.
Yeah, that's right. I think, we've spoken about this before, Andy. It's an epic distortion in commodities markets that is currently hiding behind the rise in gold prices. Really, it's not necessarily all that relevant to gold prices per se, but under the hood, the return that you can earn from moving physical gold from London into the U.S. has been abnormally large over the last months. That's now showing some signs of easing for gold in particular, but not necessarily so for silver and other precious metals.
Now, the melt up in gold, as you call it, and it really has been that over the past few weeks, you reckon we're not seeing big speculative inflows into gold?
So here's the interesting part there, right? I think the setup in gold we can summarize as heads I win, tails you lose. So in moments of time when the U.S. dollar is appreciating, when U.S. rates are rising, the appetite for gold is coming from Asia as a currency depreciation hedge. And in moments of time when U.S. rates are declining, the U.S. dollar is declining, macro funds, these are overwhelmingly Western, they look at gold in the traditional sense of a lower U.S. dollar should be good for gold. And that is the cohort that buys gold conversely. So it's a pretty extraordinary setup in gold. It's quite rare, doesn't last for necessarily very long. But for as long as this setup persists, it's a very strong context for gold.
What about silver? Is it still a poor relation to gold?
Increasingly less so. Silver has a really unique story. We're heading into its fifth consecutive year of a structural deficit. That deficit is really unprecedented in terms of its magnitude of the supply-demand imbalance that's been created by the demand boom, which has ultimately been associated with increased solar capacity around the world. Mm-hmm. Now, the setup in silver is different because we're actually, in our view, transitioning away from a demand boom and into a liquidity crisis. The pull of metal from London into the US has been so dramatic that it's draining the world's largest bullion vaulting system to such an extent that it's actually disturbing day-to-day trading activity in physical markets. So London is trading extremely tight. We think it can get even tighter, and ultimately, flat prices in silver need to rise in order to incentivize metal to come back into London from unconventional sources.
What would they be? Just long-term holders of silver for whatever reason?
Yeah, historically, there's basically a few different groups that can come into play to resolve these types of imbalances. One of which is private vaults. You have a large amount of silver that is just stored away in private vaults. These might be owned by family offices, private investors, and so on and so forth. And if the price is right, they might be willing to resupply the market with that silver. Another such venue is ETFs. ETFs also hold a significant amount of silver and can potentially be tapped if the price is right in order to resolve this imbalance. And finally, mom and pops that own silverware. Presumably, it can be remelted into a form that can be delivered back on exchanges. We haven't seen any sign that any of these pressure release valves has been tapped. And what that tells us is simply that we're not really at the strike price necessary for this to come in.
I'm wary of this because we do, over the years, we hear about a so-called silver squeeze or the risk of that, and that people who shorted silver will get caught out and they'll have to buy it back at ever higher prices. Do you think there is a prospect of that? I mean, the silver market is quite small.
Well, what we've been calling it is the silver squeeze you can buy into. Okay. And I think the critical difference there is that this isn't, a conspiracy theory relating to short contracts that need to be delivered into. The movement of metal is simply a function of arbitrage, but it's inadvertently draining the world's largest bullion vaulting system. There is, according to our estimates, just around 250 million ounces remaining that are freely available for purchase in London as of January. Every day, that number is grinding lower. But guess what? Around 250 million ounces of silver trades in spot London markets every single day on average. And so what that tells you is the more we drain it, the more that's going to put pressure on the silver market. And there is a strong academic relationship that suggests that lower inventories in a given commodity are correlated with higher volatility in that given commodity. That's what we're looking at here, and that's what we're calling the silver squeeze you can buy into.
Daniel, this is a slightly off topic here. India, Bloomberg has a look at the vast holdings among Indian households of gold. Apparently, 25,000 tons are held in India. People see it as their key to their future retirement security, and they've been doing it for perhaps millennia. I wonder, with these record high gold prices, will there be a wealth effect in India? Or I know we're speculating here, but obviously they must be happy to see gold near record highs.
Yeah, it's interesting, right? And I think in large parts of Asia, precious metals, whether they're in the form of jewelry or otherwise, tend to actually correlate quite well with the underlying price. So people could presumably resell that. The question really is, can it come in a form that is acceptable for either the London Exchange or the US Exchange? And historically, by the way, in the last bull market in silver, I believe in 2009, silver remelt from India was significant enough of a line item that you had to kind of split it out in your balance sheet for the commodity. So it could presumably come back to light, but we just have not seen any sign of that yet.
Daniel, thanks very much. It's always great hearing from you.
Thank you so much, Andy.
Daniel Galli, Senior Commodities